One is Peter Hartman here with your friendly neighborhood financial market, not legal financial advice guru, Tom Hartman. How you
That's
doing
not
today,
what I'm going to
Tom?
be known as, Peter. I'm helping people prepare for uncertainty. It has to do with financial markets and anything else to do with life. Come on.
I'm just going to go with guru, the man you want to talk to. But yesterday we gave it to you good and hard, talking about Ukraine and
No, Peter.
no.
Let's do that again. Let's take the different take.
Okay, take it off the top. Hey there, my name is Peter here with Tom Hartman. We're here to talk to you about do a walkthrough of another video, another person, another human being you should know. Her name is Cathie Wood. Tom, you want to tell us a little bit about Cathie Wood?
So Cathie Wood runs an ETF. Consider that like a stock that represents a bunch of other stocks inside of it. So instead of having to buy Tesla and Twilio and Facebook or whatever separately, you can buy this one ETF and it counts for the whole thing. She runs a series of ETFs, but the one we're going to be focused on today is the ARK Investment Trust. It focuses on tech. Now we talked about before in previous videos the idea of invested in tech because they are exponential companies, right? If a tech company hits well, the stock can go up far more than in something else because it's accessible to far more people. It's either hardware or software that scales, and it's useful for many different circumstances as opposed to a store that might be uh, very profitable or very popular in your local town. So tech has that exponential kick to it, which is why we like crypto, right, Peter? Like the idea that you're buying into something that has a known cost with understandable risk that you could lose it all, but the upside gain can be tremendous, which is how venture capitalists work. And so Cathie Wood for the last few years has been running the ARK Investment Trust. And what I find interesting about her is that she's been seen as a sort of a joke by some and a visionary by others, where she buys these stocks that people go, "This won't go anywhere. This is garbage," and then
Like Tesla.
like Tesla. And then later on, it turned out she was right, and then it goes up a lot. And then people hate on her because they don't like that it goes up. And then when her stock crashes, as it is right now, her ETF crashes. People say, "See, I told you so." She's a scammer or charlatan. She doesn't know what she's doing, and blah blah blah.
How can they say that when the whole market is going topsy turvy? Like, who's doing well right now?
Energy companies, commodities.
Yeah, but I mean, isn't everybody sort of like down in the red? Like, why pick on Cathie Wood?
Well, there's a whole thing about how the ETF is actually managed, right? So because she has a long-term point of view, in her case, about 5 years, if someone who might have bought a Tesla stock low and then sold it near the top and has that option, doesn't necessarily have the same sort of flexibility to get in and out of her positions because the way she sold her ETF is that she's planning on holding them long term. So right now, if the Tesla stock is down 20% for the year, she's not necessarily in position to have sold that at the top and then can buy it back in at the bottom. So there's a little bit of that in there, but also the bets that she's taking are just on its face of it contrarian. Like people can understand the stock market going down because of a war happening or money problems or what have you. But if the stock market goes down, what is it? The stock market is down today for the year 11%, and Cathie Woods is down. Yeah, so Cathie Woods is down year to date 37%. We're seeing here at the bottom right. Then people go, well, it was better for me to hold S&P, and so even though everyone's down, they go, well, I'm down less than Cathie Wood is, and they feel good about that. So, Cathie Woods, her holdings, they're brutal. I mean, actually, switch back to the screen there. I'll just show you the some of the top 10 holdings. So this is ARK Investment Trust. This is her actual ETF. And before COVID, which is, you see this red bar in the middle here? Before COVID, her stock was trading around $50. And then COVID hit and her stock dropped from $60 down to down 45%, down to $30. So people were like, see, I told you so. Cathie's stock is garbage and blah, 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 even though all the, everything else inside the stock market fell as well. And then her stock went down from the depths from 30 something all the way up to a massive 380% return to 160, right? So that was
Wow.
massive. I mean, the entire stock market went up, but not like this, right? So the S&P went up a lot over the last 2 years, but Cathie's stock went up bananas. So as you can imagine, as it kept going up and up, because Tesla was going up and Roku was going up, was because there was more people looking for online services, and Twilio went up, and Coin Square went up, or whatever it is. People say, well, the things that she's buying are not worthwhile. They're the shots in the dark, they're Ponzi schemes, or whatever it is. They didn't think it was justified. And so now that it's dropping massively, people think she's getting what she deserves. What I
Hmm.
find interesting about Cathie is two things. One, the bets that she's placing. If you're going to bet on technology that could go to zero, or not pay off, then you do want something. She is doing she's chasing a high reward bet, right? She is looking for 200, 300, 400, 1,000% return, like over the next 5 years. That's something to shoot for, which I find to be great, right? Your regular investment advisor, your regular broker, or whatever it is, they're happy if you make 20% in a year. And Cathie Wood is saying, no, I want us to look back and go, we annualize 200% per year. That's crypto type levels of returns. So I
Mhm.
respect that. And two, she's not like some of these other people who are. She doesn't lambaste other people. She doesn't insult them. She makes all her research, all the research that she does and her company does, is open source. She's pioneering this open source financial information. That
That's
means
right. She lets everybody know what she's investing in. You can monitor this thing. I mean, is this how unusual is this compared to other investment stocks, or however you want to call it,
well, it's not
funds,
just that,
other
because
funds?
any publicly traded company needs to release a certain amount of information, but she is also releasing information as to how she's choosing these stocks, and what her projections are for what they'll do, and what are her assumptions. Like all the research that you would normally get inside of a research firm that's proprietary, she's given away for free, because she wants people to kick the tires. She wants people to chew her out. She wants that sort of rigorous, peer reviewed sort of process accessible to everybody. It's like the ultimate in democratizing information. And if you don't agree with her conclusions, then short her stock, right? She's saying, okay, you can. I'm playing against you. Let me put all my cards on the table.
It's
Plus, she
funny.
does.
It,
Plus, she
it's funny
does a
how, I'm
monthly
sorry. Let
video,
me
Peter.
let me let me just say this before you say this. It's funny how with Elon Musk, Charles Hoskinson with Cardano, and Cathie Wood, I kind of hear the same refrain. They're open source. They're letting everybody in. They're showing things, and they're criticized. They're demonized like no other.
Exactly. And so, and plus she goes the extra mile by, she puts herself on TV. She does monthly updates for her for investments uh, on YouTube. This information readily available. She has her analysts, she has her researchers come up on, I believe they just did one. I think they've done a few other ones. These sort of like conferences online, free for anyone to access. Like, people will spend tens of thousands of dollars getting proprietary information from behind closed doors, because getting an edge is useful, is where you can make a lot of money, and she's putting that information front and center. So
Mhm.
it's like, if you're going to scam, if you're going to be a scammer, if you're going to be a con artist, there are easier ways to scam money, Peter. Bernie Madoff showed us how to do it. Chamath Palihapitiya has shown us how to do it.
Oh, how
Bill
dare you!
Hwang has shown us how to do it. There's quiet ways to become a billionaire if you want to scam people
This
out
is
of
the
the
part
money.
that I don't understand. These people keep talking about these people who are scam artists. They're trying to do incredible things and they're scam artists. And there are so many easier ways to do it, ways that people wouldn't even find out. Like, why go this route? I just don't get it.
For years, she didn't come out. She didn't show up yesterday. She's been there for years, and so then the alternative is that she's dumb. I find this to be unbelievable. Some guy who has $10,000 in his bank account is calling Cathie Wood, who must be a multimillionaire, running a huge fund, who's been wildly successful, and even now that her stock is down at $59, that stock used to trade at the lowest it was at was like what is it here, $15. So she's still up 3 4 times the money if you got in at the beginning. So you're gonna call her ridiculous? You're gonna call her clueless? I mean, you start your own ETF then. You go start your own car company. You go start your own internet firm, and then see how well you do. So I judge people based on, like I said, not the conclusions, but on the assumptions that they make. So we're gonna watch um, a video of Cathie Wood here, Peter, who has to do these videos in the midst of her stock crashing, right? And then she has to make the. She's not coming out to say, I've changed my mind. I've made a mistake, and I think I need to change. She's coming out and saying, "Look, you guys didn't believe me before, and it turns out I was right, and I believe I'm right here." Sure, she's wrong in certain things. She called for oil being $12 by the end of last year. Fine, I get it. You tell me the person who expected Russia to invade the Ukraine and all these supply chain shortages with oil that exploded her through the roof, and then I'll concede that maybe she should have known that, but
Look,
whatever.
lots of people predicted Russia was going to invade Ukraine. And so, but I mean, look, it wasn't like a sure
With
thing, but
open source information telling everybody else in order to come along with the bet, I don't think so.
look, I'm not
The
here trying
the
to poo-poo on Cathie Wood. I think that she's an exceptional human, and that she's not a scammer, and that you can't be 100%. You can't make 100% predictions and nail every shot. That's not the way it works.
Yeah, if you get 60% accuracy inside of the stock market, that's considered to be fantastic, right? So because you're gonna lose less than you win if you size your bets properly. Anyways, so we get into the Cathie Wood video over here, and I just want you to one, pay attention to the assumptions that she's making. Right, she's letting you know these are the assumptions she's basing it on, and if you disagree with those are conversations to have. But see how somebody who's managing massive amounts of money has to consider these different concerns. Like you and I sitting at home, we're worried about inflation and how much it will cost for gas. She has to worry she's going to lose $500 million. So what she says has some weight to it. So I look forward
Let's
to.
contextualize.
You haven't seen this, right, Peter?
I haven't seen it.
Yeah,
You told me I had to watch it, and we are like, "Hey, let's do it live online." Tom has seen it. I haven't. Let's contextualize this a little bit. The video is called "Inflation, Interest Rates, Russia, Ukraine, Innovation, Solving Problems." It's from ITK with Cathie Wood. It's one of her monthly updates. And we're talking about this in the context of financial collapse or golden age, right? So right now we're at a pivot point, a fork in the road. Some people believe that we all sort of believe a crisis is, well, here and will get worse. But what will this produce? Will this produce a dystopian doomsday scenario, or can this lead to something positive, a golden age? Where are we here in this moment? Is that right, Tom? And
exactly. And Kathy Wood makes a great case for, hey, things might actually be we might actually have more resources and more innovation under our belts and ready to explode than we might otherwise have thought.
And just in case, because we might forget as we watch this, to bring this up in our description here, we talk about the fourth turning. How do you want to describe how you feel this relates, or the moment that we're in relates to the fourth turning? The fourth turning, for those who don't know, is a theory of cycles, and it predicts a crisis that creates great change. A crisis happens every turning. The fourth turning is the greatest crisis. I'm not going through all the details. I'm sure Tom can explain more if it's necessary, but there's a crisis that can actually lead us to something positive or to something negative. So, how does the fourth turning relate to what we're about to watch here?
So, like you just mentioned in the fourth turning, that there's these cycles. We saw the same thing inside of the video we watched yesterday with Peter Zahan. There's this unit of time, which is the human lifespan. That what happens is that you can almost predict the future, certain characteristics of the future, based on how people were born, how they grew up, under what conditions they became an adult, and then what they did in their old age. And these cycles sort of um, they're repeated because at the end of someone's lifetime. Anyways, I don't want to go into too much detail on that because we have a whole video about the fourth turning. But what it boils down to is that these turnings, which is 20-year increments, has to do with the there are certain things that happen that are predictable to happen as people age. So as someone in the first turning from 0 to 20 years old, they have they're concerned with learning and growing and going through school and all that sort of thing. After that, they enter the workforce. They have the least amount of skills and the most amount of purchasing. They're buying the most amount of things at once. And then you have as they get older and they get into their 40s, now they're spending less, but they have the most amount of skill and the most amount of they're saving for their retirement and all that sort of thing. And then when you get into your last turning. In your 60s and up, you are no longer spending, you're saving, and you're waiting to fade out into passing away, and then the new generation is coming up as well. And so these cycles, because you know how people will react, you can sort of predict some of the qualities of what will happen in the future. Cathie does not talk about um, Cathie does not talk about turnings. What she's talking about is innovation, and the point that she's making here is that we have a massive amount of brain trust and a huge crisis. And because of that, just like we use a technology in order to try to get us out of the 2020 pandemic crisis, where we had supply chains with Amazon, we had Zoom video and communication platforms that we were able to use online, right? In any other circumstance, something that we went through last year might have completely shut down everything in such a way that you could not really communicate with other people. But we found ways of retooling around that in biotech, creating the vaccines. And what they were saying at the time was what it could be like a couple of years before the vaccine could come out, and it came out in a couple of months. So she's saying now we are in an even greater crisis, and if there's ever going to be a chance where that innovation would be turbocharged, now is the case. And she wants to make betting that innovation will succeed.
I'm looking forward to any type of good information here, especially after what we talked about yesterday. So I'm looking forward to some optimism here. I love that perspective. I'm not sure we're going to watch the entire video. It's 33 minutes. I'm not even sure we're allowed to watch the entire video. So it's there are segments here. The link to this video is down in the description. So if you want to watch the thing in its entirety, definitely go and watch it at the ARK Invest. Highly encourage you to do that. Even subscribe. Tom, I have the timestamps here. The ARK's swag for good in support of Ukraine. So maybe we'll jump
Nope, we
past
don't do
that.
that.
There's monetary policy, fiscal policy,
So
economic
what?
indicators.
So do you care about the because she talks about some of the conditions that exist right now, and we touched on that in our last video, and I think that's pretty interesting. So I think we should actually jump to the section right after swag, where she describes the state of affairs right now.
So that's monetary policy. So we got monetary policy, fiscal policy, economic indicators, market signals, and innovation. So if you just want to keep an eye on that, Tom, and let us know when we can jump forward, because we only want to show as much as is required to make our commentary. We don't want to take away from her video. And again, very much encouraging you to go and watch her video. The link is in this description below. All right, here we go. You said monetary policy, right? All right,
That's right.
let's do this.
So now let's turn to monetary policy. This week, Chairman Powell said, in all likelihood, the Fed would raise interest rates. He also did say, when asked the question in his testimony, that he would get aggressive if inflation seemed to be embedding into the system in a 70s-like scenario. Well, we thought about the analogy to the 70s, and we know a lot of, especially old-time investors who were around during the 70s, are forecasting just that, inflation embedded in the system at a much higher than expected rate. We are not expecting that. Why? It comes back to this concept of velocity, the rate at which money turns over. So I did a little more homework on velocity in the 70s. Actually, the increase in velocity started in the 60s. And in the fourth quarter from the fourth quarter of 64 to the first quarter of 81, velocity increased 21%. So the rate at which money turns over in the economy. And what that meant at that time, at least, is many people used to buy, as soon as they got more income, they would buy goods and services, and especially goods, right away, as quickly as possible, because they were afraid prices would go up or interest rates, in the case of cars and other durable goods, would go up. So buy now before prices and interest rates go up. And that became a self-fulfilling prophecy. If you look at what has happened since 1997, and I was actually surprised to see the peak in velocity this time around that long ago, from the third quarter of 97 to the fourth quarter of 2021, velocity has dropped 50%.
Oh.
Now, what we've seen is a couple of things. We saw two crises, tech and telecom bust, 08-09 financial meltdown, a lot of fear, and inflation and interest rates continuing to trend down. And so this thought that we'd have to run out before interest rates and prices went up, we didn't have to worry about that much anymore. Some people are worrying about it today, to be sure, but even so, in the last 12 to 18 months, velocity has been flat. It has not gone up. And consumer sentiment would suggest that the next leg in velocity will be down. On top of that, money growth rates have decelerated from the high at 27% in 2020 to 12.6%. That's the January reading. But if you look at money growth on an annualized basis, it is slowing down. It has slowed down in the last 3 months to the low single-digit range. So already we think there's a dramatic deceleration in money growth underway that many people are not focusing on. Fiscal policy.
1 second?
Yeah.
So this is a very important point here, right? You hear a lot of people scream about inflation and that inflation is high and prices of things are going up. And she's saying, okay, there's a fear there. But inflation, actually what real inflation is, and in the 70s, she talks about this, is that, for example, in the 70s, the baby boomer cohort came of age, right? So they started coming of age, and then so there was a larger. The baby boomers, the generation was larger than the generation before them, and so when they came into the market, there was massive millions and millions of people who were buying the same goods. Now they were buying couches, they were buying apartments, they were buying TVs, they were just massive amount of buying, and in order to set up their life. And so that when you have a large demand and a steady supply, what happens? Well, then prices for things go up because people go, okay, I'll sell it for higher since more people want to buy it. That makes sense. But the generations afterwards have never been as big. We've had less and less, because of the decline in growth rate, we've had less and less children born every year since. And so there's not this big demand push for these products and services. So what happens? That causes deflation. The products and services have to come down. Now we're in a situation where we're all scared because prices went through the roof, but they didn't go through the roof because there's a massive demand for it, right? People had the same demand that they had before, right? People are not buying more stakes and purchasing more houses and going on more vacations. They were behaving in the same way they did before, but the supply contracted because of the pandemic. And so when prices can go up, either if the demand increases and the supply stays the same, or if the supply decreases and demand stays the same. It just is imbalance. And so not only is it looks like inflation because the items that people want to buy are high, but what really happens is that it makes you less eager to spend, right? Because you're worried that you're not going to be able to get all the goods that you want, and you're not going to go out and go on a vacation right now for 4 weeks because you don't know what the future holds. So our high prices now is caused by deflation. It looks like inflation, and it's actually causing people to spend less, which means the velocity of money, the money moving around, decreases and decreases and decreases. And this is a hidden major problem. It's deflation that is unbelievable, and that you cannot stop with higher interest rates. Right? If the Federal Reserve, the central banks of the world, increase the cost of money, what do you think that'll do? That'll cause people to borrow less, right?
Increase the cost of money is increasing interest rates, so it costs more money to borrow.
Exactly. It costs more to borrow, and then you also have the issue where the increased interest rates doesn't make supply all of a sudden increase. So right? It doesn't make more TVs show up, and it won't make people take more vacations or anything like that. And so, what actually is the underlying reason? And when you listen to Jerome Powell talk about this, the reason that they would be increasing interest rates is to make people want less things,
It's
to
to force
decrease
saving,
demand.
no?
No, it's to force people it's to increase unemployment. It's to increase the amount of pain that people have, so that people are less likely to buy things. And if they decrease the demand to match the supply, well, then inflation will come down. But it's going to come down by hurting people, by causing more poverty.
All right, there's something I don't understand. From what we've talked about before, I thought inflation is not prices going up, it's the increase of the money supply. That prices don't inflate, it's the money supply that inflates. But it sounds like
Exactly.
when you're talking here that you're referring to inflation as when the price is up and deflation is when the price is down. So help me figure out that point.
So that's the confusion, right? So normally inflation is what you're saying. It's people generalize it as too much money chasing too few goods. And so people talk about the central banks around the world printing all this money. But all this money that's printing is not money inside you and I's pockets, right? If they're printed $1 trillion, you didn't get any of that $1 trillion to go buy a new house, to buy land, to buy a company or whatever. That money stayed locked within the banking system, and at most, it influenced the stock market and certain assets, so that the rich got richer and the poor got poorer. So what Cathie Wood is saying here is that this money printing, this inflation that people think there's extra money in the system, we know there's not extra money in the system because it's not being transacted. It's
That's
sort
the
of like
velocity that's down. The velocity is
exactly,
down because the money that's supposed to be there isn't circulating. So the velocity is down. So you might be afraid that there's too much money, but the money ain't moving around.
exactly. It's like I say, if I were to counterfeit $1 billion, but keep that $1 billion inside of my basement and never spend it, then it might as well not have been printed. If I spend that money, then then what happens is that the prices around you eventually will increase, because somehow the economy knows, hey, there's more money floating around. That's how you get this expectation of higher
But
higher
why are they
prices.
printing this money and then it not being used? I mean, what are the banks doing with it? Is it just when you say it's not being used, it is being used like on the balance sheet to make it appear as if something is worth more than it is. No, I mean it's being used on some level. It's not just sitting in someone's basement.
Central banks, especially the Federal Reserve, used to print money, literally print money and ship it to the banks, physical cash. But years ago, around the 19 I believe the 1950s, that started to dwindle. And back in the 90s, it became clear that to people who pay attention to these sort of things, that the Federal Reserve couldn't print money anymore. In fact, it became clear that the Federal Reserve, Alan Greenspan talks about this, they were because they weren't printing money. And so anyways, this story is very long and very interesting to me, but not interesting to you guys. So what it boils down to is that the Federal Reserve still needed people. They needed to be able to manipulate people, right? And so what they did is that they turned into an expectations based company. You hear them talk about expectation based policy, that inflation expectations are anchored around 2% year over year. What they're saying is that they do things and buy things and sell things and buy bonds and whatever it is and print money on paper to make people think that they're printed money. And if people think that they're printed money, then people will behave as if there's a lot of money inside of the system. And so you get this inflationary behavior that's not actually inflation. It's just tricking people into thinking that there isn't inflation. But we talked about high prices, right? So you can have high prices because let's say there really was printing of money, and prices would go up because there's more money chasing fewer goods, right? That's why a milkshake today costs $10, and a milkshake back in Back to the Future time costs a nickel or whatever it is. That's actual inflation in that way. But you can also have prices going up if the supply of things go down, right?
Hmm.
So when Apple came up with the AirPod Maxes, the new headphones that they came out with a couple of years ago, and there wasn't enough in stock. Well, when you went online to buy it, right, from someone who bought some extra pairs and selling it to you, they're selling it to you higher at a higher price, and you're paying it because there's not enough supply. You're competing with other people who want it too,
Like
but that's not
PlayStation 5.
exactly. That's not inflation. There's a supply issue. There's not enough of it.
So the Federal
Uh,
Reserve is artificially causing the supply to be lowered so that
No, no. The Federal Reserve, the central banks cannot affect supply. They can only affect demand, and they affect demand by making people think that they're printing money, so that people behave as if there's a lot of money around.
That's so weird. So, from what I understand, the Federal Reserve was put into place because of the boom and bust cycle, the business cycle. They recognize that there's these natural ebbs and flows to the economy, and the Federal Reserve says, "Hey, if the economy is going deflating, then we can pump it up by printing money, and if the economy is too hot, then we can slow it down by removing money from the system." But now, instead of actually printing the money in order to control the cycles, they're using expectation to control people's behavior instead.
Exactly. Now, the history of the Federal Reserve or on all central banks is a storied one. You can take a look at you can read the book, The Lords of Finance. Very interesting about the history of central banks. But essentially, to dumb it down, the central banks were created to prevent bank runs. So what happened is that there's these individual private banks, and if there's a problem in any given area, there would be a bank run, and there'd be severe money loss in any given area. Loans would default, not enough money to serve a given community, what have you. And so what happens is that the deposits were insured, were guaranteed by the federal system, so that people feel like no matter what bank I go to, it's safe, right? It used to be. Right now, we have the habit of go to any bank. You can it's just a matter of convenience. Do you like their app? Do you like their color scheme? But before, it was like you had to go and do your homework, because if you chose the wrong bank, you might lose all your money. And
Hmm.
so they wanted to get rid of that. But once they had that system in place, and they were able now to control the distribution of actual cash in the system, then it gave them power, right? If they how they modified the money supply could actually extend expansions, booms, and reduce recessions. But just like somebody who has a credit card and uses a credit card in order to pay for things, it only works if you pay off the card, right? If you use the money from your credit card in order to buy productive goods, right? Something that actually produces money, then that was an investment. You can get back the money that you borrowed from the credit card plus pay off the loan, and then you have the asset, right? That's why you do a loan. But what happened is that they just kept putting money into the system, and assets and real estate and houses and stocks or whatever were going up, and it was like this steroids. It was like assets on steroids. So if you had any assets, your assets went up in value, and in the number of dollars that you can get for them, because it was money being pumped into the system. So long story short, they didn't want to actually, they never actually wanted to pull money away from the system, right? All they ever wanted to do was just pull it enough to slow it down, because it was really rampant up, just to curb people's behavior a bit, and then expand it again in order to continue the expansion. And we've had one of the longest expansion on record in the world since the global financial crisis in 2008. And now it's coming due, because now the cost, people, anyways, they can't get more money in order to pay the loans that they had before. There's not enough money flowing around the system, and it was a fake increase in wealth. It's called the wealth effect. It looked like people had a lot of money, but turns out they didn't. It was actually hiding deflation underneath the surface, and we've seen that with the divide between the rich and poor getting wider and wider and wider.
Money is supposed to be a reflection of the productivity in your economy. And when you have a lot of dollars that are going around, it might give the illusion that there's a lot of productivity, or is there?
So I no longer believe that. That's an or not as wholeheartedly. That's a an Austrian point of view that yes, productivity can generate money. Well, productivity generates assets, right? And those assets, right? If you whether you build a whole home, whether you dig gold out of the ground, whether you make a song, and those assets are actually collateral. So what happens is that you can borrow against the thing that you've created, right? That thing becomes an asset that you can borrow against, and it's actually lending money out is what actually causes money to be created, at least in our system. And so uh,
Sounds like you're saying debt is money.
debt is money. Yes.
All right, all right. You sounding dangerously like a Democrat, Tom. No, I'm just joking. So we just listened to a segment called Monetary Policy. Monetary policy is what exactly?
Monetary policies, when the central banks do something, right? Whether they increase lower interest rates, whether they're buying bonds, whether they are buying assets, whatever the central bank does, that's monetary policy about money. Fiscal policy is whatever the government does.
And do we care to watch this fiscal policy section?
Yeah, it won't be long.
All right.
We're in gridlock. We're in a midterm election year. But we know that we are also on the other side of the stimulus payments associated specifically with the coronavirus crisis. As a result, federal outlays are falling on a year-over-year basis. That is also a break on the economy. On to economic statistics. Today was Employment Friday. That's why I'm doing this today. And the report was very strong, very, very strong. And in fact, we had non-farm payrolls up 678,000. Expectation was 481,000.
Let's jump
And
to
the
market
household
signals.
employment.
We're jumping to
Market signals, because this won't really mean much to a lot of the people who watch us, or to you for that matter.
Now, onto the markets. I'll give you the top and bottom sectors, at least for the S&P 500, over, well, year to date. And no surprise, given what has happened to the energy price, energy is the only sector that's up. It's up 33%. And consumer staples and utilities are the fill out the top three. They're down just a bit. So that's an interesting combination.
Let's just pause there for a second.
Energy.
That's very interesting there. She's saying energy, consumer staples, and utilities. So all three of those things, the reason she's mentioning that they're up or not down too much is that things that go up in a recession or depression or stay stable are the things that people have to buy regardless. So people have to buy energy, so energy is up. Staples, consumer staples are things that people buy. The food, certain types of amenities, things that they just don't usually do without. As opposed to discretionary, which is things that they might buy on a whim or just for fun or as a value add. And then utilities are electricity, internet, and that sort of thing. So when you notice in the financial sector, and this is for people who are not even trading in the stock market, when you notice that the things that are doing well are the things that people have to buy anyway, that's a warning sign that we're headed towards a recession.
You mean if they're doing well when other things aren't doing well?
Exactly. If those are the ones that are doing well and the other ones aren't, you're headed for a downturn in the economy. I don't just mean a drop in the stock market. I mean literally unemployment will start going up, opportunities will start drying up, lending will be harder to, loans will be harder to get. That the future is winter's coming, basically.
And is there a scenario where other things are going down and these economic signals are also going down? Like, what's the alternative?
Yeah. So if the alternative is that when these are being outperformed by, let's say, tech, or the broader stock market, um, uh, more volatile things like consumer discretionary and stuff like that. So when the opposite of these things, the things that people don't have to buy, go up, often they'll outperform utilities, discretionary, staples, and energy, because people want to chase higher returns than middling returns. And so but when they both go out together, it's stuff like in March 2020 where the whole market is collapsing, and so that's bad.
So that's even worse.
That's worse, but it usually, the other two scenarios is a regular ebb and flow. There will always be a period of time where the things that people have to buy do better than the things that people don't have to, and then it goes down the other way. It's just this up and down sort of roller coaster sine wave sort of situation. And so what's great about that is that when you notice it turning and you change your bets or you change your behavior, well, then you could ride the down and ride the up and make money, both ways. Just like if someone was a farmer, you don't expect them to plant crops in the winter. What they do is that during the winter they'll do other things in order to make their planted season and harvest season better later on. They'll maybe repair equipment. They'll learn new skills, or what have you. And then when springtime comes along, they plant, and when summer comes along, they harvest. It's just that ebb and flow. But when they both go down together, it's like it's a year of winter.
And so again, when these three economic indicators stay stable or go up while the rest of the market goes down, that's the worst case scenario.
No, it's not the worst case scenario. The worst
Okay.
case scenario is that they both go down together. All of it goes down together. So
Gotcha.
right now, the fact that energy is up and that the other utilities and staples are not down too much, it's sort of like, okay, this is sort of like what we've seen before. But if we see that those start going poorly, right, that even staples and utilities start selling off a little bit more, it means people are selling it because they need to. They need that money. And so when people are in a state where they have to sell things because they need to, not just because they want to, then that perpetuates more selling, because other people go, well, the price is lower now, maybe I should sell. And there's always some people who then decide to sell, and then people who now are like, crap, the price is even lower, I should sell. And then you have this sort of chain effect,
Gotcha.
this domino effect. Sorry.
Out the top three. They're down just a bit. So that's an interesting combination. Energy, we know what's going on there. Staples is a very defensive sector. That says that investors are becoming somewhat concerned about the economy. And utilities are interest rate sensitive. So when interest rates go down, utilities dividend yields look better and better, so they tend to outperform. Now, in a rising inflation environment, interest rates are not supposed to come down. And at the short end of the curve, they are not coming down, but at the long end, they are, and we'll get into that in a bit. The worst performing sectors
One quick
are
pause there.
associated with the consumer, again.
So this is important, and it's why everyone should have some education in interest rates. Like, go on YouTube and learn about interest rates. Go on Real Vision and learn about interest rates and why they matter. Interest rates are to do with government bonds, right? Government bonds. The market for bonds is way bigger than the stock market. I mean, it's trillions of dollars, and so when somebody has if someone was to buy a Tesla stock and they had $1 billion, you'd be like, oh, okay, maybe they've done some homework. They have some expectation as to some inside knowledge, some edge as to why they're placing this bet. If someone is buying $500 billion of bonds, then you go, hey, wait a second. Why is this guy willing to lock up his bonds or this pension fund or this country is willing to lock up, $500 billion in bonds over the next 30 years? If these smart money, big money players thought that inflation was really a problem, then they wouldn't lock away their money for 2% for 30 years. Because why would they? If inflation is 5%, they'll lose their money. So they must think, and this is what she's mentioning here, that the aggregate of the bond market is saying Everyone is saying inflation, but we're saying no. And so interest rates are going down. They're going down because there's demand for bonds, right? It's supply and demand. The interest rate, the yield, is how much money the person you're lending money to, how much they'll pay you extra for the right to borrow your money. So when things are going well in the economy, right, and there's all kinds of things to invest in, and you can go into real estate, and you can go to different companies, and you can start your own business or whatever, the
Yeah, to
government has to
increase.
increase the interest rate to solicit you. They'll be like, okay, fine, I'll give you 5%, 7%, 8% on your money so that you lend me your money. When things are going poorly and money is leaving the private sector and some of the other public companies into bonds, they can offer you lower and lower interest rates. So the lower the interest rate goes means the higher the value of bonds go, which means people are locking their money more and more. So the very fact that one of the largest markets in the world, larger than the stock market, is saying, nope, we're not seeing any inflation, not in 5 years, not in 10 years, not in 30 years, taking into consideration all the things that the government and people have been doing, if they're seeing that, well, you might want to take the bet as well that there's not going to be structural inflation, secular inflation.
And we don't want secular inflation. That's bad. If we don't have inflation, that's good.
It depends. That's a whole other debate whether inflation is good or bad.
Just so we're clear, for those who might not know, maybe I don't know, but a government bond is when the government solicits your money. They want to borrow your money. So then you take your money, you give it to the government, you lock it in for 5 years, 10 years, 30 years, and then you have a promise to get that money back plus interest. The higher the interest rate, which is set by the Federal Reserve, the more money you'll get back after the 5, 10, 30
It's
years.
not set by the Federal Reserve.
Oh,
The Federal Reserve targets a certain rate. They can't make people offer that interest rate. What happens is that there's a market. There's a market, and the central banks try to influence the market by setting certain prices. So, for example, right now, the Federal Reserve interest rate is at 0 or 0.25%, even though the bonds are at let's say 1.5, 1.7, 1.8. And so the market is offering more money than the Federal Reserve is saying the interest rate should be right now. That's why they're saying that the Federal Reserve is going to have to increase their interest rates later on. But anyways, it's not the Federal Reserve that sets the interest rate. They
all
at
right.
most set short dated, the short term 2-year interest rate, but they don't
All
set
right.
5, 10 years, and 30 years. I just want to give you one quick example of why inflation might be good, right? If you take out a $20,000 loan and the bank is expecting $20,000 back, and inflation is high, well, if you have to pay back that loan, let's say in 5 years, when you have to give back $20,000, that $20,000 will be worth less,
Hmm.
right? And so if you're at a job and you're making extra money, or you're getting a pay increase every year, or you run your own company and you have a growth rate that's higher than the inflation, or what have you, you like inflation. Inflation reduces your debt burden. So that's one circumstance where inflation might be good for somebody.
Gotcha. So if you lend your money to the government, and that you're getting a bond, a promise from the government in order to pay you back, that whole market is bigger than the regular stock market. If the incentive, if the reward for lending your money to the government is high, it means that the government is trying to solicit you to do it because what's happening in a market is better for you. If the return, if the interest rate is low, that means the government's like, hey, you got no better place but to give me your money. And if people are voluntarily doing that, is because it's better for them to do that than to put the money in the stock market. So,
Those are two
uh,
scenarios. There's all
yeah.
kinds of different combinations, but yeah, that's one way of thinking about it.
So I'm still trying to understand. I know, I'm sorry, I don't want to take too long here. I'm just trying to understand. Um, if people are locking their money away in government bonds because they're taking it out of the market, right? They want to kind of safe hold their money there. That means what's happening in the market ain't good. And the ain't goodness is happening because of inflation.
No, well,
Like, what's the problem that's causing that?
what's the problem is that growth is slowing,
So
productivity is slowing,
recession.
recession.
Because there's a recession, people are going towards bonds. So people moving over to bonds is an indicator that we're entering a recession.
There's so much to say for that, but
Oh my
yes.
God. I want to know, is
In
Kathy
the
saying
situation
good
that we're
news
in,
or bad news here? This is what I want
what
to
she's
know.
saying is that the inflation that everyone is scared about is
Yeah.
not inflation in what they actually, it's not real inflation. It's
Because if
supply
it was
chain.
real inflation, the interest rates would be going up, but they're not going
Exactly.
up.
But they're not
They're
going up.
going down, which means it's not inflation. All right. I'll figure it out at some point. All right.
It's like if there was a sudden cold snap in May, and then you started changing your thing. Okay, we got to prepare for winter now, and you started closing up your farm. And she's saying, don't do that. It's just a cold period, right? And it could be a really bad cold period, but don't all of a sudden think winter's coming in May.
Hmm.
You
I
understand?
like that. Yeah. No, that sounds good. That sounds like people are overreacting by putting their money into bonds, or should they still put their money into bonds?
Well, it depends why, because the bonds, there's a whole thing. There's a reason why the bonds are a multi-trillion dollar market. It's because the last person to default in a country is the government. And so sometimes things can be really bad and you're scrambling, you go, well, I might as well put it in bonds because everything else I don't know what's going to happen. So it's not always a good sign.
Gotcha. Gotcha. I like that. It's like I go to the casino, and sometimes I decide I'm going to put my quarters in the gumball machine because for sure I'm
There you
getting
go.
a gumball. Maybe I won't get a gumball, but I'm pretty sure I'll get a gumball. All right. I think I got it. You got to reduce everything down to gumball machines, Tom, and then I'll understand. Okay, here we go.
I think the loss of purchasing power is a big problem for the consumer. So, consumer discretionary, consumer services, and technology, which, despite innovation getting a booster shot from problems, as innovation solves problems, it is a high beta sector. And so many investors just shy away from it when trouble seems to be on the horizon. As far as the bond market, the long treasury bond yield peaked in mid-February at 2.06 and is back down to 173. Now, what's been very interesting is the yield curve, which peaked in March of last year at, I think, roughly 160 basis points. So the difference between long-term interest rates and short-term interest rates, 160 basis points. And that was a reflection of easy monetary policy, short rates being much lower than long rates. Now that the fear is that the Fed is going to increase a number of times, we're seeing short-term interest rates up a lot, certainly in the context of recent history. But long rates not going up as much. And so the yield curve has compressed to 25 basis points. Now, we're getting close to an inverted yield curve, meaning long rates below short rates. And that is often a sign that the Fed is too tight and real growth is going to disappoint and inflation is going to be lower than expected. We think that is the case, and we've thought so for some time. High yield spreads, so the difference between high yield bonds, interest rates, and treasury bond yields, they are moving up and corroborating that outlook. Now, they haven't spiked, and it doesn't suggest duress out there yet. But they're not much above pre-COVID levels, indeed. But if they move up rapidly from here, we will be in a territory that would suggest that some companies are finding it difficult to service their debt. In other words, their business is falling off. Commodities, they're on fire. We believe this is a supply problem much more than a demand problem. I'm sure there's a scramble to build inventories of anything now, anything in the energy complex, any of the metals that come out of Russia, food out of the breadbasket of the Ukraine. Interestingly, the commodity price increases are in the face of the dollar increasing. The dollar increasing tends to put pressure on prices, but this supply problem and maybe inventory hoarding is overcoming that. The dollar is going.
All right. I don't want to play everything, Tom. I want
Got it.
to
Jump to
make sure we
innovation.
don't get in trouble here. All right. So essentially, we were just talking about what she said there. And so it sounds like she's saying good news. It sounds like she's saying people are worried more than they really should. They're worried about inflation, but inflation is not the thing to worry about because the at least long term interest rates are not set to go up. So there's concern about what's going on out there, but it shouldn't be. But because there's this concern, and it looks like maybe even the Federal Reserve is believing this concern, they're not putting money into the system, which keeps velocity low, which will hurt productivity and growth in the economy. So this is encouragement. Hey, get money out there because you're going to have lower growth if you don't do this. The thing you're worried about is not happening. Winter isn't coming.
Well, just keep in mind she's only talking about people who have money, right? The poor or the lower middle class, even middle class and poor people are going to suffer with the high prices. They don't. That's why when you talk to people with less money, they go, "What do you mean there's no inflation? I have to pay whatever $20 for a steak. I used to pay $5 for or whatever it is." And it's like,
Mhm.
yeah, I understand. She's saying I get that the people who don't have savings, people don't have the cash flow, they're going to be hurt. But that's when you're talking about investing. You don't invest based on that. You invest based on what is the potential returns you can have over a given period of time. And so she's saying if everyone is is acted as if their money's on fire because of inflation, if they're worried about the demand and supply and all sort of thing, people are behaving in such a way, thinking that the future is going to be one thing. But she's saying all the signs are pointing that it's not just that; it's the opposite.
But if we
And
don't act
so,
like it, then it's going to hurt poor people in the middle class.
well, it's going to hurt in the short term anyway, right? If recessions hurt, there's nothing you can do to stop that. But and so if the right now the Federal Reserve is likely to raise interest rates, not because they actually think inflation is really here. It's just that because for a year now they've been saying that inflation is transitory, that there is no inflation, or that the inflation will roll over. But when prices are skyrocketing and oil is through the roof and people are screaming inflation from the rooftops and they're getting called into Congress and Senate in order to justify, or what are they going to do? What are you going to do about this? They have to do something,
And
right?
they're in the
But they're
expectation game. So they have to.
exactly. So then they go, well, if we raise interest rates, one, people will think we're doing something to fight inflation, so that'll curb inflation expectations. It'll lower inflation expectations, and simultaneously, it'll hurt. It'll pull money out of the system, which will drop prices. It'll cause a
Unemployment.
massive amount of pain and lower the amount of demand that's out there. So it's sort of like uh, hobbling someone so that they go, see, now you can't go on the vacation. Now the vacations will go down because we've cut everyone's legs off. It's like it's brutal. It's not
It's
the way I
like
go
a
about it, but what are they going to do?
So it's like a hypochondriac goes to the doctor day after day. Doctor, I'm sure I have cancer. I'm sure I have cancer. I'm sure I have cancer. Eventually, the doctor's at his ends wits. He's like, I'll give you chemotherapy. You get the chemotherapy. And you're like, oh, thanks, doc, for curing my cancer.
Exactly. That's exactly right. Or gumballs.
Or okay, so okay, are we watching more of this? We got market signal innovation. I guess this is the part that we
Yes,
really care about.
exactly.
All right. I don't want to play this whole thing, Tom. So let's not play this whole thing. I don't want
All
to
right, I'll
take
tell you
away
when to
from our
stop.
video. All right. Don't get my channel banned.
Markets. Now on to innovation solves problems. Our analysts have been providing me with a running list. Here are some of them. So the crypto networks are proving their worth as a neutral technology platform. We're seeing donations of both Bitcoin and Ether to the Ukraine. I think it's 50 million, if I'm not mistaken, in the last week. And we're also seeing Bitcoin as a currency hedge for Russian citizens who are watching the ruble get hammered here. And, these are not the oligarchs. In fact, as we were discussing at our brainstorm today, there's not enough Bitcoin out there for the oligarchs to hedge. And they have been hedging for years anyway. This is for the average Russian citizen who actually is aghast, many of them, as we hear it, aghast at what's going on in Russia. Tesla is providing free supercharging in Poland. Poland's taking in, of course, a lot of refugees.
So she's talking about here about tech
And
solving
of course,
problems.
we know that
No, just continue.
longer term, electric vehicles are going to help with the demand destruction of oil. I think the prices alone will destroy a lot of demand for oil and accelerate the shift to electric vehicles.
Yeah.
And especially, we believe robo-taxis will be electric, and they'll be on the road 50 to 60% of the day. So that acceleration away from oil will happen as we move into the autonomous realm. We're seeing a lot of talk about renewables, especially nuclear, to reduce dependence on Russia. Of course, solar and wind, but I think nuclear is becoming less of a negative, even to some environmentalists who have studied it a little bit more carefully. We're seeing, of course, the social platforms providing real-time updates and providing, a glimpse into the horrors that are taking place there. And I think that has put a lot of pressure on financial institutions and others to boycott or stop doing business with Russia. It's terrible for the Russian citizens who do not want this invasion. But I think we've never seen the financial system used as such a weapon.
Actually, I want to stop it there. If you want to hear what Cathie Wood has to say, I'm sure she has more to say on this important topic here in the segment of innovation. Go over to her channel. We put the link down below. I think she's given us enough of a glimpse here. I do like, it is optimistic to think that it's tough when these situations are happening to look for the silver lining. But I mean, why not look for the silver lining? If this accelerates our move away from fossil fuels, away from oil, if innovation and technology can be used in order to make lemons out of lemonade here, then that's definitely something positive.
Yeah, and I would strongly recommend that when you go look at Cathie Wood's videos, start a few videos back. Heck, even start in 2020 when she started doing this. It is a great education to see, and I say this all the time. You want to see how people with a wealth mindset actually operate. What are the things they consider, and how do they operate in the world? It is absolutely invaluable. It helps reduce the noise. You hear people yell and scream online, or even when you're watching the news or speaking with people in your environment. It's hard to tell what's true or not, right? Some things sound right, but when you see these people make predictions and you hear their assumptions and you get to follow through where they made a mistake, where they got it right, it's really a fantastic education experience for you. So take the time to do it. It takes just a few hours, and you have a YouTube, you have realvision.com, you have people like us you can talk to just to kick the tires. Don't be one of those people who just let the soundbite on the news or just some tweet online decide for you how you're going to plan the next 2, 5, 10 years of your life. We're going through a change right now that is unlike anything we've seen in recorded history. And so you want to take this seriously. You take your education seriously so that you take a step into the oncoming winter prepared to survive the winter and to thrive in the spring and summer that follows.
Speaking as one with a gumball brain, I don't understand about 90% of what I listen to, but I listen to it anyway. There's something about letting the information wash over your brain. And if you're feeling like, I don't have a basis for this, I don't have the capacity to understand this, just have the words enter your ear over and over in these different contexts. Cathie Wood, Raoul Paul at Real Vision, and others, they have a way of explaining things that over time it will sink in to some degree. And like Thomas talking about, the insight that you get that allows you to implement foresight is invaluable. And those people who are able to foresee the future, able to look ahead, see ahead to any degree, that is the key to success. One of the key features for people who are successful is their ability to see beyond the now and see into the future. So don't, if whatever excuse you might have in your brain that says, oh, I don't want to, it's boring, I don't want to do this, get that out there. Have a jump start on your future. Let this information wash over your brain, and who knows, you might get lucky enough, you might find yourself predisposed to this type of information like Tom is, and you'll be explaining it to other people. Who knows? Who knows? You might find out that you're smart. I didn't know Tom was smart. I had no clue. I had no clue. I had no clue. This whole time Tom was smart, I had no idea. All right.
Right.
You're just building websites. Turns out he understands way more than I do. All right. Do I feel insecure about it? No. No. Right. Do I feel belittled and ashamed? No. He's my twin. Yeah, sure. Are we supposed to be the exact same? No. That's fine. That's fine. Tom, this is a lot of fun. I'm glad that we got to watch this together. I'm not sure that, I mean, I definitely would have understood the core of it here, about innovation and then the value that this conflict and this crisis does provide. But I wouldn't have understood everything that's going on. And it was really good hearing you talk and explain it. Thank you for dealing with me. I was like stubbornly trying to understand and explain things back to you. But I was just trying to play the role of someone who might watch this. Like this Happy for Change is not a financial channel, right? So I try to play the role of someone who really doesn't know what's going on. And if I feel like I can understand something moving forward, then I feel like the people who are watching are moving forward. Thank you for your patience. I really appreciate that.
No
All right.
problem.
Anything else to say?
Look, we're not a financial news channel. If there's an asteroid coming to Earth, I would tell you about that. If there were aliens coming, I would tell you about that. And if there was a way of, entering another dimension and people coming in from a multiverse, I would tell you about that. You just want to be prepared, and if you can, make money along the way. So get out there, get messy, and what does Boga say? And
in the wise words of Bob Ross, get messy. No, I can't remember. I can't remember. I've listened to it 1,000 times. I can't remember it. My name is Peter Hartman.
I'm Tom Hartman.
And you're watching Jumpstart Live. Thank you so much for watching, everyone. Have a nice day, and let's head for that golden age.